Hi, I am Batusha Khatija and today I will start to discuss sustainability reporting with a focus on Petronas gas Berhad and Tenaga Nasional Berhad, the two major players in Malaysian energy and utility sector. In recent years, sustainability has become a key concern due to rising awareness of climate change, environmental degradation and social responsibility. There is also increasing pressure from investor, regulator, customer and the public for companies to operate responsibly and disclose their sustainability performance transparently. For energy and utilities company, sustainability issues are especially significant because the operation involves large-scale infrastructure, high carbon emission and long-term environmental impact. As a result, sustainability risks today are not merely ethical issues but are financial material risks that can directly affect profitability, business continuity and long-term enterprise value. Therefore, sustainability reporting plays a critical role in ensuring transparency, accountability and long-term business resilience. The adoption of FAR661, FAR662 and the Malaysian and SRF Phase 2 is critical to understanding sustainability reporting for Petronas Gas Berhad and TNB. Let me start with FAR661. FAR661 is designed to provide general sustainability-related disclosure which require companies to explain how all sustainability risks and opportunities could affect enterprise value. This is significant because it connects sustainability directly to strategy, risk management and financial reporting. It also helps stakeholders on how to evaluate their non-financial issues that might impact revenue, cost and long-term profitability. For instance, for a gas company like Petronas, S1 requires reporting on how environmental incidents, regulatory compliance or community relations could affect operation contract renewal or asset values. Next, IFRS2 focuses specifically on climate-related disclosure. It asks companies to provide detailed information on climate risk, greenhouse gas emission, transmission target, and governance structure. For energy and utilities companies, which are a major contributor to carbon emission, this standard ensures investors and stakeholders that can assess climate-related financial risk. For example, TNB shift toward renewable energy and energy efficiency initiative can be quantified and disclosed under IFRS-S2 to show alignment with climate goals and regulatory compliance. Finally, an SRF Phase 2, the Malaysian National Sustainability Reporting Framework, ensures local companies align with global sustainability standards while providing guidance tailored to Malaysian regulatory and operational context. And SRF Phase 2 also prepares companies for future mandatory reporting requirements, make it easier for companies like PGB and TNB to remain compliant and comparable internationally. In summary, these three frameworks together strengthen the credibility, transparency and strategic relevance of sustainability reporting. They also make reporting more decision useful, showing not just historical performance but also how sustainability risks and strategy affect future enterprise value. Then, we will proceed with company overview of Petronas Gas Berhad, which is a leading gas infrastructure and utilities company in Malaysia and operates as a subsidiary of the Petronas Group. Established in 1983 and listed on Bursa Malaysia, the company plays a crucial role in ensuring energy security and reliable gas supply across the country. Its operations are integrated across gas processing, gas transportation, regasification and utility services, and also supporting industrial, commercial and residential energy needs. From a financial perspective, it reflecting a strong operational performance and efficiency. The company benefits from a long-term contract and regulated operation which provides stable earnings and reduce market volatility. This stability allows the Petronas Gas Berhad to invest in sustainability initiatives such as emission reduction, energy efficiency improvement, and environmental compliance. Then, Tenaga Nasional Berhad or TNB is a Malaysian largest electricity utility company and play a central role in national electricity generation and distribution. Established in 1949 and corporate in 1990, TNB operates as a government-linked company supporting Malaysian economic growth and energy security. The company operates across the entire electricity value chain, including power generation, transmission, distribution, retail electricity services, and digital innovation. TNB regulate core utility business, provide a stable revenue, which is diversify energy, mix support with affordability, reliability and sustainability. Due to its scale and environment footprint, TNB faces significant environmental, social and climate-related risks, making the comprehensive sustainability reporting are very essential for transparency and accountability.
So I will continue the presentation with sustainability disclosures and assurance analysis for IFRS-S1. First, we evaluate clarity and connectivity, which examines how clearly sustainability objectives are linked to corporate strategy and operational execution. For Petronas, sustainability commitments are closely aligned with corporate strategy and governance, particularly through the long-term commitment to achieve net zero carbon emissions by 2050. These commitments are not presented in isolation but are connected to enterprise risk management and translated into measurable operational outcomes such as greenhouse gas emissions reduction, safety performance, and environmental management indicators. This clear linkage enables stakeholders to understand how sustainability prioritize influence business decision and operational performance. In comparison, Tenaga Nasional Berhad or TNB demonstrate clarity and connectivity through a structured sustainability framework built around defined strategic pillars, including clean generation and energy transition. These pillars are supported by operational enablers such as capital allocation, governance structures, digitalization, and talent development. This structure clearly illustrates how sustainability ambitions are embedded within the company's business model and daily operations. Overall, both companies show strong clarity and connectivity. However, Petronas places greater emphasis on linking strategy to operational outcomes, while TNB focuses more on clearly structured strategic frameworks and execution pathways. The second indicator assesses specified and materiality, focusing on whether disclosures provide quantitative, decision-useful information on sustainability issues that are most significant to the business. For Petronas, disclosures are highly specific and material. The company reports quantitative outcomes such as emissions reduction achieved through 20 targeted abatement projects, resulting in a reduction of 156,546 tons of CO2 equivalent. Petronas also addresses material operational risks such as hazardous waste management, achieving a 93% 4R rate that exceeds internal targets. These disclosures directly relate to the environmental and operational risks inherent in the oil and gas sector and provide stakeholders with clear insight into performance and risk management effectiveness. In contrast, TNB focuses on material climate transition risks associated with electricity generation. The company sets clear time-bound emissions intensity targets, including a 5% annual reduction from 2024, a 35% reduction by 2035, and a net zero target by 2050. Quantitative disclosure of Scope 1, Scope 2, and selected Scope 3 emissions further enhances decision usefulness. In summary, Petronas provides more granular project-level performance data, while TNB emphasizes strategic targets and transition pathways, reflecting differences in their business models and material sustainability risks. The third indicator examines consistency and integration, specifically whether sustainability considerations are embedded across governance, strategy, risk management, and performance measurement. At Petronas, sustainability objectives are consistently integrated into corporate strategy, enterprise risk management, and operational decision-making. Climate-related and environmental risks are managed alongside with other business risks, and performance is monitored using aligned metrics such as emissions, waste, water usage, and compliance outcomes. This demonstrates that sustainability is not treated as a standalone initiative but is embedded within the company's overall management framework. Similarly, TMB integrates sustainability across its strategic pillars, risk management framework, and core business segments, including power generation, grid operation, distribution, and retail. Climate and transition risks are embedded within enterprise risk management, and progress is tracked using consistent indicators such as emissions intensity and energy transition metric. Overall, both companies demonstrate strong consistency and integration, indicating that sustainability considerations are embedded into business strategy and operations rather than reported separately. The fourth indicator focuses on transparency of boundaries and assumptions, which evaluates whether reporting scope, methodologies, time horizons, and limitations are clearly disclosed. For Petronas, sustainability disclosures distinguish between operational boundaries and selected value chain activities, with separate reporting of Scope 1, Scope 2, and Scope 3 greenhouse gas emissions. The company also explains measurement approaches and acknowledges estimation uncertainties, particularly for value chain related emissions and water data. This level of transparency allows stakeholders to better interpret sustainability performance and understand data limitations. For TMB, transparency is demonstrated through clear separation of Scope 1, Scope 2 and selected Scope 3 emissions categories, supported by detailed methodology notes. The company discloses multi-year data, defines base years for targets, and explains data restatements and methodology revisions. These disclosures enhance clarity regarding assumptions and improve the credibility of reported data. In conclusion, both companies provide sufficient transparency regarding reporting boundaries and assumptions, although TNB offers more explicit methodology explanations and base year disclosures. The final indicator examines comparability, assessing whether sustainability disclosures are comparable across time and with industry peers. Both Petronas and TNB provide consistent sustainability metrics over multiple reporting periods, allowing stakeholders to perform meaningful trend analysis across time. The use of standardized indicators, such as greenhouse gas emissions, support temporal comparability. However, explicit quantitative benchmarking against industry peers is limited for both companies. Instead, peer comparability is partially supported through external ESG assessment. TNB inclusion in the FTSE for Good Bursa Malaysia Index and MSCI ESG ratings, as well as Petronas participation in sustainability indices, provide relative assessments against other companies using standardized criteria. While useful, these assessments do not offer direct numerical comparison with peers. As a result, comparability across time is strong for both companies, while comparability with peers remains limited, indicating an area for potential improvement. In conclusion, both Petronas and TNB demonstrate robust sustainability-related disclosures aligned with IFRS-S1 principles. Differences in disclosures focus reflect their distinct business models, with Petronas emphasizing operational outcomes and risk management, and TNB focusing on strategic transition, planning, and long-term targets.
These slides compare PGB and TNB across 4 pillars: governance, strategy, risk management, and metric and targets. For governance, PGB score 4 because climate oversight is integrated into board and SRC or BSC committees, which showing strong accountability. And for TNB, score 5 because it has a dedicated CSO and sustainability division, reflecting full integration into corporate decision making. Next is strategy. PGB score 4 because it used the 3R strategy and gas as a transition fuel, linking climate risk to operation and value change, though financial impact analysis is limited. And for TNB score 5 because reimagining TNB 2.0 align climate strategy with long-term value and national energy transition goals. Risk management, PGB score 4 because climate risk fully integrated into ERM, considers carbon tax and floats, uses scenario analysis. And for TNB score 5 because has a dedicated climate risk framework managing both transition and physical risks. For metric and targets, PGB score 4 because disclose scope 1 and 2 emission, which is 33% reduction by 2030 reported but not fully verified. And TNB score 5 because disclose the emissions, renewable energy data and measurable 35% intensity reduction target by 2035, which is tracked annually. In conclusion, PGB demonstrates strong climate governance and reporting but with some verification limit on target. TNB demonstrates more mature, structured, and measurable climate-related practice across all pillars, which fully align with ISSB expectation. On this slide, we compare PGB and TNB across 5 levels of sustainability assurance. Starting with score 1, no assurance. This does not apply to either PGB or TNB because both companies have independent verification. PGB includes an independent limited assurance statement in its Sustainability Report 2024, while TNB provides a statement of assurance in its Integrated Annual Report 2024. This shows that neither companies rely solely on unverified disclosure. Score 2, internal review, is also not applicable. PGB's disclosure are not reviewed solely internally as they engage a third-party assurance provider and TNB has internal review mechanism but these are supplemented by external assurance. In other words, both companies go beyond internal checks, ensuring credibility of their sustainability information. Next, score 3, planned assurance, is not applicable. Both companies have already completed assurance for 2024, so they do not merely plan future verification. The main assurance level is score 4, which is limited external assurance. PGB engaged Serum Cars International to perform a limited assurance engagement over selected sustainability indicators following ISAE 3000 revised standard. The scope covers selected indicators but not entire report. And TNB also provide limited external assurance for selected indicators, but the assurance provided and standard are not specified, and not all ESG disclosures are covered. The key difference is that PGB clearly state the providers and the standard, which increase the transparency, whereas TNB confirm assurance but give less methodological detail. Limited assurance means the provider verifies certain indicators but does not provide full or reasonable assurance over the entire report. And for score 5, reasonable or full external assurance is not applicable to either company. Neither PGB nor TNB provide full assurance for the entire sustainability report, which is standard practice in the industry. In summary, both companies have moved beyond no assurance or internal review, and limited external assurance is the main level for both. PGB demonstrates slightly higher transparency by specifying the assurance provider and standard. Overall, both companies show robust sustainability assurance practices, ensuring credibility and reliability of their climate and ESG disclosure.
In this session, I will present and compare the financial performance of Petronas Gas Berhad and Tenaga Nasional Berhad, focusing on how key financial ratios reflect each company's capacity, credibility, and readiness to support sustainability initiatives. The analysis covers profitability, liquidity, and leverage ratios. First, we examine profitability, which indicate a company's ability to generate earnings that can be reinvested into sustainability and ESG initiatives. First, return on assets. Petronas Gas Berhad records an ROA of 10.26%, demonstrating strong efficiency in utilizing its asset base to generate profits. This high asset productivity allows Petronas to internally fund sustainability initiatives such as decarbonization projects and cleaner energy investments without heavily relying on external financing. In contrast, Tenaga Nasional Berhad reports a much lower ROA of 2.76%, reflecting weaker asset efficiency. While TNB owns extensive infrastructure, the lower return limits internally generated funds. meaning sustainability investment may require external funding or phased implementation. Next, return on equity. Petronas achieved an ROE of 13.51%, indicating strong value creation for shareholders. This level of performance supports continued reinvestment into long-term sustainability strategies while maintaining investor confidence. TMB's ROE stands at 7.56%, which is comparatively modest. This lower return suggests tighter constraints on retained earnings, potentially limiting the scale and speed of sustainability-related investments. Next, net profit margin. Petronas records a high net profit margin of 29.42%, reflecting effective cost control and strong pricing power. This provides a substantial financial buffer to support ESG initiatives such as emissions reduction and safety improvements. Meanwhile, TMB's net profit margin is 8.34%, significantly lower due to regulated tariff and rising operational costs. This narrower margin restricts discretionary cash flow, making sustainability investments more dependent on regulatory support or government incentives. Next, we assess liquidity, which reflect the company's ability to meet short-term obligations, including sustainability-related costs. First, current ratio. Petronas Gas Berhad reports a strong current ratio of 2.41 times, indicating excellent short-term liquidity. This suggests the company can comfortably meet sustainability-related obligations such as environmental, compliance costs, and community development commitments without disrupting operations. TMB's current ratio of 1.19 times indicates adequate but limited liquidity, while short-term obligation can be met. The narrow buffer may constrain TMB's ability to absorb unexpected sustainability-related expenditure without careful cash flow management. Second, quick ratio. Petronas further demonstrates liquidity strength with a quick ratio of 2.38 times, showing that it can meet immediate obligation using highly liquid assets. This enhances its ability to respond quickly to urgent ESG-related costs. TMB's quick ratio is 1.11 times, which, although acceptable, provides little margin for unexpected sustainability expense. This implies potential reliance on external financing or internal fund reallocation for sudden ESG commitments. Finally, we examine leverage, which indicates financial risk and the ability to finance sustainability initiatives through debt. First, debt to equity ratio. Petronas records a low debt-to-equity ratio of 0.32 times, reflecting a conservative capital structure. This low leverage enhances its credibility as a potential issuer of green or sustainability-linked bonds, as additional borrowing would not significantly increase financial risk. TMB debt-to-equity ratio is considerably higher at 0.92 times, indicating greater reliance on debt. While this supports large-scale infrastructure and renewable projects, it also increases financial risk and may limit future borrowing capacity for sustainability financing. Next, interest coverage ratio. Petronas demonstrates exceptional debt servicing capacity with an interest coverage ratio of 24.34 times, meaning operating profits far exceed interest obligations. This significantly strengthens investor confidence and supports long-term sustainability financing. In comparison, TMB interest coverage ratio of 2.42 times is much lower. Although still acceptable, it suggests a smaller buffer against earnings volatility, making additional sustainability-related borrowing more risky. In summary, Petronas Gas Berhad consistently outperformed Tenaga Nasional Berhad across profitability, liquidity, and leverage ratio, indicating stronger financial capacity, higher credibility, and greater readiness to meet future sustainability expectations. Its robust financial position enables sustained investment in ESG initiatives with minimal financial strain. While TMB remains financially stable, its lower profitability, tighter liquidity, and higher leverage suggest that sustainability investment must be carefully managed and may rely more heavily on external financing and regulatory support. This section presents the overall findings on the relationship between sustainability reporting quality, and financial performance for Petronas Gas Berhad and Tenaga Nasional Berhad. Overall, the analysis identifies a clear connection between sustainability reporting and financial performance for both companies. Although the strength of this relationship differs, both Petronas and TMB demonstrate strong alignment with IFRS S1 and IFRS S2, supported by standardized disclosure, quantified sustainability targets, and limited external assurance. These practices enhance transparency and stakeholder trust. Importantly, sustainability disclosure are not treated as standalone narratives, but are integrated into corporate strategy, risk management, and performance evaluation, indicating that sustainability is recognized as a core business consideration rather than a compliance exercise. For Petronas Gas Berhad, the linkage between sustainability and financial performance is particularly strong. The company's high profitability, strong liquidity position, low leverage, and very high interest coverage provide substantial financial flexibility. This enables PGB to internally fund decarbonization initiatives, safety improvements, and operational efficiency programs without placing strain on financial stability. As a result, PGB's sustainability commitments are highly credible as its climate targets and environmental performance are supported by reliable data and sufficient financial resources. Overall, PGB demonstrates a high level of readiness to meet future sustainability expectations and to access sustainability-linked financing with minimal financial risk. In contrast, Tenaga Nasional Berhad demonstrates a strong commitment to sustainability through robust governance structure and long-term strategic alignment with national renewable energy objectives. However, lower profitability, tighter liquidity, and higher leverage constrain the amount of internal funding available for sustainability investment. Consequently, TMB's sustainability progress is more dependent on external financing, regulatory support, and careful investment planning. While this does not undermine by the company's credibility or commitment, it highlights the greater financial challenges TMB face in achieving its sustainability goals while maintaining overall financial stability.
Despite Petronas Gas Berhad having relatively strong sustainability practices, the company still faces several key challenges in sustainability reporting, particularly when assessed against the requirement of IFRS S1 and IFRS S2. One major challenge is data quality, consistency, and completeness. Petronas Gas Berhad operates multiple facilities across gas processing, transportation, regasification, and utilities. As a result, sustainability data such as greenhouse gas emission, energy consumption, safety performance, and environmental incidents are collected from different operational sites and internal systems. This increases the risk of data inconsistency, estimation error, or reporting gaps, which can reduce the reliability of disclosed information. From an IFRS S1 perspective, inconsistent sustainability data make it more difficult to clearly demonstrate on how the sustainability affect the enterprise value and financial performance. For example, without consistent emission data, stakeholders may find it challenging to assess the company exposure to their carbon pricing, regulatory changes, and transition risks. Another challenge is the limited integration between sustainability reporting and financial reporting. Currently, sustainability information is often reported separately from financial statements, which may reduce user ability to understand the financial implication of their sustainability risks, such as compliance costs or capital expenditure for emission reduction. This is a key area highlighted under IFRS S1, which emphasizes the integration of sustainability information with their financial disclosure. Additionally, the lack of independent external assurance on their sustainability information may reduce stakeholder confidence. Without assurance, investors and regulators may question the accuracy and the reliability of ESG data, potentially affecting the company credibility. Therefore, addressing these challenges is critical for Petronas Gas Berhad to strengthen their quality, transparency, and suitable for its sustainability reporting.
This section presents a strategic recommendation to address the data complexity and assurance gap arising from Petronas' extensive global operations and explains the implication for governance and long-term value creation. The core recommendation is the implementation of an enterprise-wide digital ESG data architecture supported by blockchain technology and Internet of Things or IoT sensors. By automating ESG data collection directly from upstream and downstream assets, such as flare meters, emissions monitoring systems, and safety sensors, Petronas can significantly reduce its reliance on manual data inputs. This automation improves accuracy and consistency across business units while reducing greenwashing risks as environmental and safety data are captured at source and preserved in a tamper-resistant digital trail. To support this transformation, Petronas should establish an internal control over sustainability reporting or ICSR framework that mirrors the rigor of financial reporting. This includes standardized calculation methodologies, clear documentation requirements, and defined accountability structures. In addition, appointing regional sustainability controllers across all global operations would ensure uniform application of reporting standards and strengthen data verification process. Together, these measures would prepare Petronas to transition its sustainability disclosures from limited assurance to reasonable assurance by independent third-party auditors. These improvements also have significant implications for corporate governance, as global standards such as IFRS S1 and IFRS S2 become mandatory. The legal and reputational risks associated with inaccurate sustainability data will increasingly resemble those of financial misstatement. This development requires closer integration between the Audit Committee and the Sustainability Committee, shifting the board's role from passive oversight to active fiduciary accountability for non-financial disclosures. From a long-term value creation perspective, integrating financial and sustainability reporting is critical to maintaining Petronas' social license to operate and lowering its cost of capital. High quality, assured ESG data reduce information asymmetry, strengthen investor confidence, and positions Petronas as a best-in-class candidate for green financing and ESG-focused institutional investment. Moreover, access to accurate, real-time operational data enables predictive maintenance and early risk detection, protecting the group's valuation from major environmental or safety incidents.
No. Next, Tenaga Nasional Berhad. Tenaga Nasional Berhad face even more complex sustainability reporting challenges due to its large-scale, diverse operation and significant environmental impact. One of the main challenges is managing and standardized ESG data collected across numerous subsidiaries, power plants, transmission networks, and distribution units. Given the variety of energy sources and operational systems involved, ensuring consistency, accuracy, and comparability of sustainability data is particularly challenging. For an IFRS S2 perspective, the climate-related disclosure presents a major challenge for TNB. As a large electricity generator, TNB must report on greenhouse gas emission, climate risk transition strategies, and emission reduction targets. However, measuring emission accurately across the different generation assets and projecting future emission under their various transition scenarios require a complex data modeling and assumption, which increases reporting complexity and uncertainty. Another significant challenge is meeting stakeholder expectations for transparency and forward-looking disclosure. Investors, regulators, and the public increasingly expect TNB to clearly explain their long-term decarbonization strategy, capital investment in renewable energy, and alignment with national climate commitment. If disclosures are perceived as vague or overly narrative, stakeholders may question the company's commitment and their credibility, especially when given its significant environmental footprint. Lastly, similar to Petronas Gas Berhad, TNB also faces challenges related to their limited integration between their sustainability and financial reporting, as well as the absence of comprehensive independent assurance. Without strong integration and assurance, it becomes difficult for stakeholders to fully assess on how their climate-related risk and transition plan can affect TNB financial performance and long-term value. Therefore, strengthening sustainability reporting is crucial for TNB to maintain their stakeholder trust and support a successful energy transition.
Next, the strategic recommendation for Tenaga Nasional Berhad, focusing on improving ESG data integration, governance, and long-term value creation. To manage over 150 ESG variables across its nationwide operations, TNB must move away from fragmented manual tracking toward an integrated digital ESG operating system. This system would leverage IoT sensor and smart meters already embedded in the national grid to automate data collection and establish a single source of truth for critical indicators such as carbon intensity, energy usage, and safety performance. Automating data capture at the asset level significantly improves data accuracy, consistency, and timeliness, while reducing reporting inefficiencies. This digital system should be supported by a standardized data governance framework aligned with upcoming IFRS S1 and IFRS S2 requirements. Through this framework, TNB can adopt double materiality reporting, which captures both the environmental impacts of its operational and the financial risk climate change poses to its assets. In addition, the establishment of a dedicated ESG internal audit task force would ensure that non-financial disclosures are verified with the same rigor as financial statements. This prepares TNB for a transition from limited assurance to reasonable assurance, while significantly reducing the risk of reporting inconsistency. Beyond reporting improvement, this transformation will fundamentally reshape corporate governance. ESG oversight will shift from a compliance-based function to a strategic board-level priority. As ESG performance becomes more transparent and auditable, the board of directors will face stronger fiduciary accountability with executive remuneration more clearly linked to verifiable ESG targets. From a long-term value creation perspective, high-quality ESG data reduces uncertainty related to the energy transition and lowers the TNB risk premium. This enables access to lower-cost financing instruments such as sustainability-linked sukuk and strengthen investor confidence. Ultimately, enhanced transparency reinforces TNB's social license to operate, ensuring continued trust from regulators, investors, and the public, and positioning TNB as a resilient leader in Malaysia's national energy transition roadmap.